Okay, let's unpack this. Imagine having like a shortcut to understanding what truly moves the market. And it's powered by something you probably use every day. Today, we're diving deep into a fascinating new study that explores just that, the surprising intersection of AI and stock markets.
Right. And the source material for our deep dive today, it's a really interesting paper called Can ChatGPT Forecast Stock Price Movements? Return Predictability and Large Language Models.
Okay.
It's very recent research, actually,
Mm-hmm.
from Alejandro Lopez Lira and Yuhua Tang at the University of Florida. The latest version just came out September 13th, 2024.
Got it. So, our mission for you, our listener, is basically to pull out the most important insights from this research. We're going to try and peel back the layers, show you the really surprising facts, get into the why behind AI's, well, almost uncanny abilities here.
And what it all means, right, for information, finance, the future of AI.
Exactly. We want you to walk away feeling genuinely well informed, without that feeling of information overload. So, let's set the stage, the core finding. These researchers, they wanted to know something pretty fundamental. Could these large language models, LLMs, like ChatGPT,
The ones without special financial training.
right, without any specific finance background, could they predict stock prices just by reading news headlines? And this is where it gets, well, really interesting.
It really does. They found this pretty remarkable empirical result. They tested a strategy, self-financing, rebalance daily.
Right.
And it simply followed ChatGPT-4's recommendations, buying stocks with good news, selling stocks with bad news.
And the result?
An average daily return of 38 basis points. That's before transaction costs, mind you.
38 basis points daily. Wow. Okay, for those maybe not deep in the weeds, what does that translate to?
Well, here's the bottom line. Compounded, it came out to a cumulative return of over 650%.
650%.
Yep. In just over 2 years, basically October 2021 to December 2023. That kind of performance, it definitely makes professional fund managers, sit up and take notice.
I bet. And it came from a language model. You mentioned risk-adjusted returns, too.
Exactly. The Sharpe ratio, which measures that, was an astonishing 3.28 for ChatGPT-4. Exceptionally high. It significantly outperformed other models and the broader market during that time.
Okay, so this is huge. But what does it mean practically? Could I, an individual investor, just hook up ChatGPT to my trading account and expect that? Is it achievable?
That's the million-dollar question, isn't it? And it's where the crucial nuance comes in. The strategy was designed to be implementable, in theory.
Oh, so?
Well, for news out before 9 a.m., you could trade at the opening, exit at the close, news after 4 p.m. the day before, trade the next open, exit the next close. So technically possible.
There's a catch.
There's always a catch. Transaction costs are the big limiter here.
Okay.
The study found it was still profitable at 5 basis points round-trip cost.
Which gave
Over 300% cumulative return. Still amazing. And even at 10 basis points, it was over 150%.
still very impressive.
But at 20 basis points, the strategy became unprofitable. So what this strongly suggests is that you'd need absolutely minimal transaction costs for this specific strategy to work. And that's likely, well, infeasible for most individual unsophisticated investors, as the paper calls them.
Right. So no, not quite a simple plug and play for everyone hoping to buy that yacht.
Not with this exact setup, no.
Okay, so clearly not a get-rich-quick scheme for the average person, but let's drill down into the signals themselves. Was ChatGPT equally good at picking up good news versus bad news?
That's another really key finding. There was a definite asymmetry.
Meaning,
While both buying on good news, the long leg, and selling on bad news, the short leg, contributed, the predictability was much, much stronger for negative news.
interesting. How much stronger?
The short leg, selling stocks with negative headlines, delivered an average daily return of 29 basis points. That's a Sharpe ratio of 2.12.
Pretty strong.
Very. But the long leg, buying on positive news, only 9 basis points daily, with a Sharpe of 0.90.
Wow, that's a big difference. Negative news seems to be a much clearer signal for the AI. Any thoughts on why that might be?
Well, it could be just how markets work. Bad news often causes a sharper, maybe more immediate reaction, a clearer drop that the LLM can pick up on more reliably than, say, a gradual rise on potentially ambiguous good news.
That makes sense. And did this work across the board, like big companies, small companies, or just the less watched ones?
Good question. It wasn't just limited to small or illiquid stocks. Even when they took those out of the sample, the strategy still pulled in over 300% cumulative return.
So it works on large liquid stocks, too.
Yes, it does. However, the model did predict returns more strongly in the smaller stocks.
Okay, why is that significant?
It ties into those limits to arbitrage theories. Basically, the idea that it's harder for big players to profit from small inefficiencies in smaller companies because of things like trading costs or not being able to trade large volumes, so the signals might persist a bit longer there.
Right, the inefficiency hangs around. What about news during the trading day?
They looked at that too. Intraday news. And yes, significant returns there as well. Strategies that jumped in 15 minutes after the news hit and got out by the close. Over 450% cumulative return.
Whoa.
And even holding until the next day's close still yielded over 350%. It really highlights that speed matters. Getting that information processed and acted on quickly seems key.
Incredible performance data, which, it really makes you wonder, doesn't it? How did this general AI, ChatGPT, stack up against traditional financial sentiment analysis, the tool specifically built for this?
And this is where it gets even more compelling, perhaps. The researchers directly compared it. They found ChatGPT-4 significantly outperformed traditional methods, specifically citing the data vendor Ravenpack.
Outperformed how?
When they put both ChatGPT's sentiment score and Ravenpack's score into their regression models, Ravenpack's score basically lost its statistical significance.
So ChatGPT's score essentially made the traditional score redundant.
Exactly. It suggests ChatGPT is capturing something deeper, some nuance in the language of those headlines that the standard tools are missing.
Okay, so we've seen the impressive results, the outperformance, but how? How is an AI not specifically trained for finance doing this? Let's try to unpack the theory behind this edge.
Right. The researchers didn't just find results, they also built a theoretical model to explain them. It kind of weaves together the LLM tech itself, constraints on how information is processed, and those limits to arbitrage we mentioned.
And this model makes predictions.
Yes, testable predictions. And their findings strongly support them.
Okay, so what's prediction number one? Is it just about using any AI?
No, not at all. That's the first key point. The model predicts there's a critical threshold in AI capability. You need a certain level of sophistication.
Like a minimum power level?
Sort of. Only LLMs that cross this threshold can profitably predict returns. And they showed this empirically. Basic models like GPT-1, GPT-2, BERT, they showed little to no forecasting ability, often negative Sharpe ratios, actually.
So the early AIs couldn't do it.
Right. Then you get more advanced models, like GPT 3.5, that's the 175 billion parameter one, or Distopart MNLI. They showed some predictability, but it was much weaker than ChatGPT-4.
Which has?
And estimated 1.76 trillion parameters. The difference is huge. This supports the idea that return forecasting is what they call an emergent capacity.
Emergent capacity.
Yeah, like a new skill that only appears or emerges once the model reaches a certain massive scale and complexity. It wasn't explicitly programmed in, it just sort of happened.
Fascinating. So you need the really big, sophisticated models. Does that complexity also help them handle more difficult information, more nuance?
Yes, exactly. That leads to the second key prediction. Complexity relates to interpreting complex information. They tested this by looking at news complexity.
How do you measure news complexity?
They used the Flesch-Kincaid readability score. Low score means high complexity, dense, hard to read stuff.
Okay. And
only the advanced LLMs, like ChatGPT-4, showed a strong ability to predict returns from that high complexity news. It got a Sharpe ratio of 1.45 on just those difficult headlines.
while the simpler models?
They struggled. But interestingly, for low complexity news, the easier stuff, many models actually performed reasonably well.
So complexity matters most when the news itself is complex. Makes sense. Did they look at different types of news, like articles versus press releases?
They did. And ChatGPT-4 was robust across both independent news articles and company-issued press releases. Sharpe of 2.55 for articles, 2.0 for press releases.
And that's significant. Why? Especially the press releases part.
Because press releases can have, well, spin, corporate bias, strategic framing. The fact that ChatGPT-4 performs so well there suggests it's more resilient to that kind of potential manipulation than less sophisticated models, which struggled more with the press releases.
Right. It can see through the corporate jargon better, perhaps. Okay, what about the bigger picture, the market itself? Does using AI like this change the market?
That's the third key prediction. The model suggests that as more investors adopt these powerful LLMs, it should actually boost market efficiency by increasing the overall information processing capacity of the market. If everyone can understand news implications faster and better, the information should get baked into prices quicker.
Which would mean less opportunity to profit from the predictions.
Exactly. It should reduce return predictability over time.
And did they see evidence of that happening?
They found what they call suggestive evidence. It's hard to prove definitively, but they observed a clear decline in the performance of their ChatGPT strategy during their study period.
A decline? How much?
Well, remember that over-eye sharp ratio of 3.28. That was the average. But if you break it down by time, in late 2021, it was a staggering 6.54. In 2022, it dropped to 3.68. And in 2023, it fell further to 2.33.
Wow, that's quite a drop.
It is. And it correlates really well with the massive increase in GPT model capabilities and just how many people started using them during that exact period.
That's a really interesting point about the market potentially self-correcting or maybe adapting. It's like the very act of using these tools makes the advantage they provide smaller.
It certainly seems plausible, an arms race maybe, between the AI finding edges and the market absorbing them faster because the AI exists.
What does that mean if the edge is always moving? And you mentioned earlier that the effects seem to last a couple of days. Can you elaborate on that?
Right, the underreaction point. They found that the market seems to initially underreact to the news that ChatGPT is analyzing.
So the price doesn't jump immediately to the correct level?
Apparently not entirely. ChatGPT-4's scores predicted returns reliably over the next 2 trading days. But after day 2, the predictive power vanished.
So it takes about 2 days for the information signal ChatGPT picked up to be fully reflected in the stock price.
That's what the data suggests. An initial underreaction, then a gradual adjustment over roughly 48 hours.
Okay, this is all incredibly cool, but it still feels a bit like magic. This black box idea. How do these LLMs actually think? Did the researchers try to look inside?
They did, and that's another fascinating part of the paper. They developed this really neat interpretability framework to try and shed some light on ChatGPT's reasoning process.
Okay, how did they do that? How do you interpret an AI's thoughts?
It was a 2-step method. First, they used something called surrogate modeling. Basically, they trained simpler, transparent models like linear regression to mimic or approximate how ChatGPT was making its predictions or scoring headlines.
So using a simple model to understand the complex one.
Exactly. It helps identify which factors seem to be driving the scores and the performance. Then the second step was topic modeling, using a technique called BER topic.
Topic modeling, like finding themes.
Precisely. They use it to find distinct, human understandable themes or topics within the news headlines themselves and within the explanations the LLM generated for its scores.
Ah, so they looked at the AI's own reasoning too.
Yes. And this allowed them to link those high-level themes directly to what the LLM was doing and how well it performed on news related to that theme.
Very clever. So what did they actually find when they cracked open that black box? Any surprises in how ChatGPT was making these calls?
Oh, absolutely. Some really specific, intriguing insights came out. For instance, take insider transactions.
Okay. Buying or selling by company execs.
Right. GPT-4, they found, tended to rate stock transactions by executives as being too negative. It overreacted, basically.
Yeah.
And that actually hurt performance by about 16 basis points for news on that topic.
Interesting. It was too pessimistic about exec trades.
Seems so. But for transactions by directors or the chairperson, GPT-4 assessed them accurately, and that led to really strong outperformance, like 30 to 60 basis points.
Huh. And the older model, GPT 3.5.
It struggled more with the director transactions, so that highlights a specific area where GPT-4 got smarter or more nuanced.
Okay.
Share repurchases, buybacks. Both GPT models correctly saw these as strong positive signals. News about buybacks led to performance gains of almost 1%. They got that right.
Good. Any areas where it struggled?
Yes. Convertible notes, ChatGPT seemed to struggle there, often overestimating the positive impact of issuing them. That resulted in a performance decrease of about 50 basis points for that topic. Yeah. And another one was awards. You know, when a company wins an award, both models tended to overestimate how much that positively impacts the stock price, which also led to lower performance on news about awards. Seems the market doesn't care as much as the AI thought.
So some very specific hits and misses. You mentioned GPT-4 improved on GPT 3.5 in some areas. Were there other examples? Was it always better?
GPT-4 definitely showed clear improvements in several specific areas. A big one was reverse stock splits.
Generally seen as negative, right?
Very negative, usually.
Yeah.
GPT-4 rated them extremely negatively, much more so than GPT 3.5 did. And that accurate, strong negative signal led to a huge 3.2 percentage points of outperformance for GPT-4 compared to 3.5 on that topic alone.
Wow, that's a massive difference.
It really is. GPT-4 also did better in some niche areas, like news about electric vehicles or the fitness industry.
But it wasn't always an upgrade. GPT-4 sometimes did worse.
Correct. It wasn't a universal improvement. For example, news about cloud strategic partnerships and expansions. GPT-4 seemed to rate those two positively compared to GPT 3.5, leading to about a 15 basis point underperformance difference.
So I got overly optimistic about cloud deals.
Apparently so, relative to its predecessor. And similarly, it rated news about hotel acquisitions too low compared to GPT 3.5. So it really shows the evolution is complex. Models get better overall, but maybe develop new subtle biases or misinterpretations along the way.
This whole interpretability framework sounds incredibly valuable then. It doesn't just tell us if it works, but starts to show how and where it works well and where it stumbles, and how that changes between models.
Exactly. It helps move beyond the simple black box idea and gives us actual insights into the strengths, weaknesses, and the evolving reasoning of these LLMs in a financial context.
So bringing it all together, this deep dive has really shown us that LLMs aren't just, for writing poems or code anymore. They are having a real measurable impact in financial markets right now. So the big question, what does this all mean for you, the listener?
Well, I think there are a few key takeaways. For investors, it's pretty clear empirical evidence that LLMs can predict stock market returns, at least to some extent.
But with that transaction cost caveat for individuals.
Definitely. Direct application of this strategy is tough for individuals. But the finding itself is powerful. It might lead to new tools, new funds, new platforms that leverage this capability. More broadly, though, this work really underscores those emergent reasoning capabilities we talked about.
The idea that AI is developing skills we didn't explicitly program.
Yes, in complex economic tasks. It shows how AI might fundamentally change how information spreads and how decisions get made, not just in finance, but potentially in many areas.
What about regulators?
They absolutely need to be aware of this. LLMs could significantly affect market behavior, how information gets disseminated, how prices are formed. It's something they'll need to monitor and understand.
And it gives us new insights into the market itself.
For sure. It sheds new light on market efficiency or inefficiency and those limits to arbitrage theories. It gives us a new lens to look at how information actually impacts prices.
Okay. That is a lot to consider, and it leaves us with a pretty provocative thought, doesn't it? If these off-the-shelf AI models, the general-purpose ones, are already showing the surprising ability to predict market movements, what happens next? What happens when models are specifically built and fine-tuned just for finance? Or, maybe even more profoundly, what happens when they can act autonomously on their predictions?
That's the big question, isn't it?
How might that fundamentally change the very nature of information, of decision-making, not just in finance, but maybe everywhere? It's definitely something for you to think about, to mull over as you continue your own deep dives into how AI is reshaping our world.